Welcome to the Deep Dive. Today we are jumping straight into American Express, AXP, and their really strong Q3 2025 results.
That's right, big numbers, and our job today is clear. Unpack that strong beat, sure, but really figure out why they felt confident enough to significantly bump up their full-year guidance.
Okay, let's do it. So the headline figures definitely had that surprise element. Earnings per share, $4.14.
Yeah, much better than the $3.99 forecast. That's, what, a 19% jump year over year? Pretty substantial.
And revenue followed suit.
It did. Came in at $18.43 billion, beating the $18.05 billion expected. So an 11% increase there year over year.
And the market reacted instantly.
Oh, yeah. The stock popped 3.67% in pre-market. Investors clearly liked what they saw. It validates the direction.
So a strong Q3. But the really interesting part is what this means going forward, that guidance change.
Exactly. It shows real conviction from management. They're now calling for full-year revenue growth between 9% and 10%.
Okay.
And critically, the EPS target got a big lift. Now $15.20 to $15.50 for the full year.
Wow. And wasn't the street already kind of expecting good news?
Well, yes, that's what's interesting. 7 analysts had actually already revised their earnings estimates up recently. So Amex didn't just meet heightened expectations, they exceeded them and confirmed that optimism.
Right, so that's the what. Now, let's dig into the why. The consensus seems to be it's all about their premium focus, specifically that big Platinum card refresh.
Absolutely. That's the core narrative here. This wasn't just a minor tweak, it was a major strategic move. And the initial data, just from the first, 3 weeks after launch, mid-September to early October.
Yeah, that window.
The results were immediate and, frankly, huge.
How huge are we talking? Doubling acquisition sounds impressive, but sometimes that means lowering standards,
Right, but that's not what the sources suggest happened here. They literally saw new U.S. Platinum account acquisitions double compared to the period right before the refresh. Double.
Okay, wow.
And it wasn't just signups without engagement. Get this. Over 500,000 requests for the new Mirror card.
500,000. Let's pause there because, for you listening, what exactly is the Mirror card? Why the excitement over a piece of plastic, essentially?
Well, it's more than just plastic, right? It's that new mirror finish card they offered as an option. It's flashy, it's different, it screams premium.
Oh, okay. The status symbol aspect.
Exactly. The fact that 500,000 people actively requested this specific form factor in just 3 weeks tells you a lot about brand heat and how much customers are buying into that refreshed premium identity. It's emotional connection, not just transaction.
And when you think about the scale of the Platinum program overall,
it puts it in perspective, doesn't it? That Platinum franchise alone is responsible for something like $530 billion in spending globally each year. So getting this refresh right, it's absolutely central to their whole plan.
And this success isn't happening in a vacuum. It's built on the underlying network strength, or like overall spending.
Yeah. Overall card member spending accelerated, up 9%. Or 8% if you adjust for foreign exchange. We always look at that FX-adjusted number, to see the real organic growth without currency swings confusing things.
Makes sense. And a big driver of letting people spend more is simply giving them more places to spend. Acceptance used to be the old knock against Amex.
Used to be, yeah. But they've poured resources into closing that gap, now accepted at, an estimated 160 million places worldwide.
That number is staggering.
It really is. Almost a 5-fold increase just since 2017. So you take high-spending customers and dramatically increase where they can use the card. Well, that's a pretty direct line to more spending volume.
Okay, let's shift gears slightly. Beyond new customers and where they spend, what about the core revenue streams like fees and interest?
Both very strong. Net card fees were up 17% FX adjusted. And get this, that's the 29th quarter in a row of double-digit growth in card fees.
29 quarters, that's incredible loyalty, especially if fees are going up.
It really shows the stickiness of that premium model. And net interest income, NII, that was up 12% too, mainly because more people are carrying revolving balances on their cards.
Which always brings up the next question. Credit quality. Are they taking on more risk to get that NII growth?
That's the natural question, but the data says no. Credit metrics are holding steady, still described as best in class. The net write-off rate was 1.9%, which is flat compared to last year. But here's the really telling detail, tying back to the Platinum refresh.
The FICO scores. That definitely jumped out at me, too.
It should. It shows real discipline. They actually found that the average FICO score of new Platinum applicants after the refresh was 15 points higher than before.
Wait, so they doubled the number of new accounts and the average credit quality went up.
Exactly. Doubled acquisitions, improved credit quality. That speaks volumes about their targeting and, frankly, the desirability of the refreshed product among high-quality consumers.
That is impressive. And underpinning this is that demographic shift we keep hearing about, the younger generation.
Yeah, millennials and Gen Z. It's not just talk anymore. It's a huge part of their business. They now account for 36% of total spending.
36%. That's the same as Gen X now, right?
Exactly the same share. They've successfully captured that next generation.
And here's the really crucial part for you listening. These younger members aren't just signing up, they're using the card way more often.
That's the key insight. The average number of transactions for a U.S. millennial or Gen Z card member is about 25% higher than for older members.
25% higher. What does that imply?
It means they're using it for everything, not just big trips or fancy dinners, but, daily stuff. Coffee, streaming, online shopping, it's become a go-to payment tool, which drives massive transaction volume.
Okay, and quickly, before we get to costs, how do things look internationally?
Still very strong. International spend up 13% FX adjusted, and in 3 of their top 5 markets outside the U.S., spending grew 18% or more, so the model travels well.
Right. Now, the flip side, offering all these new benefits, doubling acquisitions that cost money, variable customer engagement costs, VCE.
Yep, VCE was up 14%. And if you drill down, the card member services part of that jumped 25%. That's the direct cost of those new platinum benefits hitting the books.
So this is expected. It's the investment part of the strategy.
Absolutely expected. And understanding the accounting here is really important for seeing the next couple of years.
Explain that lag for us, the cost versus revenue timing.
Okay, so think about it like this. Amex adds a new benefit, maybe a quarterly credit for a streaming service. When you, the cardholder, use that credit.
Amex pays the streaming service.
Right. And that cost hits Amex's expenses immediately in that quarter. It's part of that VCE number.
Okay, it's spent straight away.
But the money Amex gets to pay for that benefit, the higher annual fee they charge you, that revenue gets spread out. Accounting rules mean they recognize it evenly over the 12 months your card is active. So they recognize only 1/12 of the new fee revenue each month. But the cost can hit all at once if the benefit is used early.
Precisely. So you get this temporary mismatch. Costs go up now, but the full revenue benefit takes time to flow through. The CFO actually said it takes about 2 years to fully lap the impact, meaning for the higher fee revenue to fully catch up in the year-over-year comparisons.
So they knew this margin pressure was coming in Q3 and Q4 and likely into 2026.
Exactly. They explicitly said they did this with our eyes wide open. It's a strategic choice. They're prioritizing long-term growth, acquiring and keeping valuable customers over maximizing short-term margins.
And they reiterated their long-term goals despite this.
They did. Still aiming for that 10% plus revenue growth and mid-teens EPS growth aspiration over the long haul. This is an investment towards that goal.
Okay, makes sense. Now, no analysis is complete without looking at the potential bumps in the road. What risks did management highlight? The usual suspects, to some extent. They're obviously watching the broader economy. Any slowdown could impact spending, even for their base. And competition is always fierce in financial services.
But they seem pretty confident about their customer base being different.
Very confident. The CEO used that phrase, bifurcated economy, essentially saying, look, our typical customer is more insulated from day-to-day economic pressures than the average consumer. That belief underpins their willingness to invest aggressively right now.
Right. So summing it all up.
Well, I think the core takeaway this quarter is really the validation of that premium membership model. The results, the guidance raise, the platinum success, it all points to their strategy working. And honestly, doubling acquisitions while improving credit quality, that's
Right.
just superb execution.
What really sticks with me is that generational shift in the usage patterns. Circling back to that bifurcated economy idea, if things remain reasonably stable, and you have this huge cohort of Millennial and Gen Z customers who transact 25% more often. Could that engagement rate become the single best predictor of Amex continuing to outpace its rivals? It's definitely something for you to think about how loyalty and frequency in that premium segment might shape the future.